Gold and silver have been on a tear lately. They were both up significantly in 2025 and started 2026 off just as strong. It's times like this where folks are understandably wondering, are we closer to a beginning of a multi-year trend higher, or are we near the end, even a bubble about to collapse and send prices far lower? Folks would be forgiven for wondering this because most recent run up in precious metals goes back to 2011. And that episode was defined by a high degree of speculation, and prices came down rather abruptly. And they actually went nowhere for a bunch of the 2010s. It wasn't until 2019, 2020 where precious metals finally started to see some life again. So the question is what we're seeing lately the sign of another speculative bubble, or is it something indicative of something much more structurally at play in the global financial system? I believe it's the latter, and here's why. For centuries, global powers and their currencies have enjoyed periods of rising ascension and power and strength and prosperity, but eventually turning into strain. And these cycles typically last 100 years or so, where you have a leading global power, global reserve currency. Think back in history, we had Portugal at one point, the global power economically and otherwise, then Spain, then France, then Britain, in post-World War II, the United States. And to this day, arguably, the U.S. Is still very much in control of that position. If history is any guide, these cycles change. And many historians and macro observers believe that we're in one of these major phase changes. This doesn't happen overnight, but these slow tectonic shifts have very impactful and profound impacts on everything from currencies to financial markets and how everyday people should have their assets properly positioned. And this framework is just not theory. It's actually based upon study of many, many centuries of actual historical economic cycles. And there's a predictability to these cycles that is almost uncanny, even if it doesn't feel that way in the short term. And if this really is late stage paradigm shift or regime change, it really has profound implications in the near term and longer term, of course, for everyday investors, especially those folks who have built a retirement nest egg that are worried about, can this nest egg provide for me throughout my retirement period and cover the cost of inflation and my everyday needs? Hello, I'm John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. We work with everyday people across the country who have many concerns, and in this late stage of the market cycle, they're very concerned about market volatility, risk, and all the sorts of that. We've been longtime proponents of precious metals as a very important part of a properly diversified and risk managed portfolio. In this video today, I'm going to talk about some of the structural things that we think are in play that likely leads us and many other folks to conclude that this recent rise in precious metals is not over. It's always going to be subject to volatility and sometimes very shocking volatility, but we do think there's a multi-year trend intact here. And again, it's a backdrop of policy and economic reality that leads us to believe that. Many people are familiar with the name Ray Dalio. He's a pretty outspoken and very revered longtime investment macro manager. He's the founder of the world's largest hedge fund, Bridgewater and Associates. Two of his famous books are, one is Principles for Dealing with the Changing World Order, and the more recent one is How Countries Go Broke. And Ray Dalio has been on the airwaves quite frequently lately, and he talks a lot about the studies that he has done, he and his team at Bridgewater have done, of economic cycles and paradigms of currency and debt crises that have echoed throughout history in terms of countries that are in a leadership role kind of succumbing to arising other ascending powers, in both economically and otherwise. And he thinks we're in the very late stages of one of those cycles. Ray points to some of the common hallmarks of a late stage cycle. And this is kind of reminiscent. We have talked for quite some time in our communications with clients and through videos we've done about a social cycle referred to as the fourth turning or the turnings. And this is a social dynamic and cycle that was popularized by the authors Strauss and Howe. And we've talked about that. Ray Dalio looks at things in a similar way, but from purely an economic lens. And they have very many commonalities. And it's not surprising that the economic backdrop sets the social mood and vice versa. So Ray talks about some of the common signposts of these late cycles, paradigm shifts. He talks about significant money printing. He talks about dramatic increases in the indebtedness of countries and companies and individuals. He talks about a loss of fiscal discipline and perhaps kicking the can down the road on so many economic and fiscal issues that need to be solved, but the policymakers just don't have the spine or the backbone to solve those problems and find it easy easier just to kick the can down the road with ultimately, very negative consequences in the end. He also talks about how these kinds of dynamics predictably lead to gaps in wealth and disparity. Higher income and owners thrive while those in the lower rungs of the economic ladder struggle to even just make ends meet and get by on day-to-day needs. These are common outcomes in late cycles of the economic and fiscal cycle. And these are also lead to some of the social cycles that are talked about in the fourth turning paradigm that Strauss and Howell have put out. Ultimately, this leads to rising tensions and an outright conflict. Literal conflict between classes, between political parties, and everything in between. It's a very disruptive period, but it plays out in slow motion, almost like folks don't realize it, the proverbial frog sitting in boiling water without realizing it. So I'd like to touch upon where we are in the cycle of things here in the U.S. on these signposts that Ray Dalio and others have talked about. And to do that, I'm going to refer to some slides that I prepared. So the first data I want to talk about is the money supply. Again, one of the hallmarks of late stages of economic cycles is the lack of discipline and the significant issuance of currency and money, what we call fiat money. Fiat currencies. These are currencies that don't have any intrinsic value in and of themselves, but rather have been decreed to have value by the governments that issue them. So I'd like to turn to a chart on the US money supply. This is a chart that goes back to the mid-50s. And it's a chart right off the Federal Reserve database. And it's of what's called M2. It's one of many metrics of money supply, how much money is in circulation in the US economy. And this includes, literally paper currencies and coinage, but also things like bank deposits and CDs, things that are either in very liquid, current spendable form or very easily could be converted to that. And what you see here is a unabated rise in the money supply as measured by M2. And then you notice something here. It's a little subtle on this chart, but surely the numbers speak to the lack of subtleness. Right after the great financial crisis, which is this gray area here, that's the recession in the great financial crisis and the housing bust, the printing of money, literal printing of money out of thin air by the Federal Reserve went into overdrive. And then it really went into overdrive in response to COVID. This is a spike right in the wake of COVID. And after a brief slowdown, we've resumed a very sharp upward trend. We are at literally the record amount of money in the system of all time. And the consequence of that is very predictable. And even though it's not observed every day, over time, it's highly observable. And this is a chart in the upper pane that shows the consumer price index, the rate of inflation. And you can see since the post-World War II era, inflation, CPI, as measured by CPI, has gone up over 1,400%. Now, that's a shocking and eye-popping stat in and of itself, but it's what it does to the purchasing power of the US dollar. The dollar that people use to buy everyday things. Over that same period of time, the US dollar has lost over 93% of its purchasing power. In other words, what a dollar could buy back in the mid-40s can only buy about 7 cents worth of stuff today. That is a dramatic decline in the purchasing power of the dollar. I talked briefly about the prior last bubble, if you will, in precious metals back in 2011. And it's important to note that much of the modern arsenal of monetary policies that are in the framework today were never even used prior to 2011. So since 2011, we've had several rounds of quantitative easing, and the most egregious or most dramatic of which was QE3, which was quantitative easing 3, which was launched at the beginning of 2013. And this was a never before used policy where there was an open-ended amount of money printing by the Federal Reserve to literally print money out of thin air and go into the marketplace to buy bonds from the private marketplace. So this chart shows the total assets on the Fed's balance sheet, the Federal Reserve's balance sheet. And you can see here, prior to the great financial crisis, the balance sheet hovered below $1 trillion. It was, $800-900 billion, got up to just under $1 trillion before the housing bust really kind of kicked in. And then in response to the housing bust, you had a massive increase in the balance sheet. Again, this was literally money printed out of thin air by the Federal Reserve, and they went and exchanged those paper dollars, if you will, for bonds, treasury bonds and mortgage bonds with the private marketplace. And that's why you saw a ballooning of the Fed's balance sheet. Even by 2014, 2015, it had gone to over $4.5 trillion. Now, if this isn't bad enough in the US, this same playbook was undertaken by governments the world over. So this was a policy measure that was on steroids, literally. And even though the Fed stopped their expanding their balance sheet, it was flat for a bunch of years here. The rest of the world kept going. So the total balance sheet of the world's central banks continued to rise, again, literally by money being printed out of thin air. And then the real bazooka happened in the wake of COVID. And you can see this very big spike in the Fed's balance sheet. It got up to $9 trillion, over 9 times what it was prior to the housing bust of 2007, 2008. And then in recent years, the Fed tried to, quote unquote, normalize their policies, in effect, reverse all the policies that they said would be temporary back in this phase. And they could only get it down to about $6.5 trillion. And just a few months ago, they announced that they were stopping the balance sheet reduction and we're going to keep it frozen there. So that's on the monetary policy side of things. Again, these are the classic hallmarks of late stage cycles of the economic cycle. These are cycles that have played out over hundreds of years, predictably. So let's look at the fiscal side of the situation. This is the amount of debt that the Treasury issues to fund the operations of the US government. And in this chart, you can see 2 things. I've got federal debt in the blue line. You can see that line has continued to go up at an increasingly fast pace. The slope of that curve has increasingly gone more vertical. We haven't been slowing down our spending and debt issuance. We've been increasing it. And as a percentage of GDP, you can see by the green line, and that's measured on the right axis here, we've gone into overdrive. It got up to about 130% of GDP. We had some moderation with the economic recovery after COVID, but you can see it's trending higher again. This is the classic stuff that economic cycles, long-term economic cycles are made of, and ultimately lead to the demise of fiat currencies and really the powerful standing of the then current reserve currency. Now, the US dollar has enjoyed reserve currency status for many decades. And this is quite a privilege for a country to have. Prior to the US, Britain had the world reserve currency. And what does a reserve currency really do? It's a privilege that the country that has that standing really enjoys. It allows them to borrow more cheaply, to fund deficits. Everyone that wants to borrow money, if you're a homeowner or whatever, you want to get it at the cheapest rate possible. When you have the reserve currency, you can borrow more cheaply than anybody else. It also attracts capital. The world over, people want to invest their reserves and their savings. Everyday individuals, as well as overseas central banks, want to invest in the reserve assets. So that further supports the reserve standing of that currency. But in late cycles, this tends to get complacency set in. And what does it result in? It results in the unsustainably high and increasing debt levels that we just looked at. It's policymakers using the quick fix of monetary policies rather than austerity to really solve problems. It results in the can kicking that I talked about earlier. These are all problems that eventually come home to roost. And unfortunately, when they do, it's usually very disruptive economically and financially. It also results in other countries trying to erode the power of the standing global power. So we've talked a lot about other countries trying to de-risk themselves from the US dollar as their medium of exchange. The world's central banks themselves have turned increasingly to precious metals in the last handful of years, and their intentions to do so furthermore in the years to come. I think in the last survey of the world's central banks, over 70% of the world's central banks anticipate over the coming 5 years that they will continue to increase their holding of gold, for example, as their reserve asset, and reduce their holdings of US dollars. These are big tectonic shifts that are kind of predictable, if not somewhat stealth under the surface. We've seen developing countries band together to find ways to issue a competing currency, the so-called BRICS currency, for example, backed by real things. And this gets back to the whole history of the US dollar. There was a time where the US dollar was backed by precious metals, actually backed by gold. And the final nail in the coffin there was in 1971, when President Richard Nixon slammed the gold windows, where people could no longer exchange US dollars for literally gold bullion. And that unleashed a untethering of the fiscal discipline that has gotten us to where we are today. Hard money, even, a couple descriptive terms. And precious metals for millennia, and certainly the last several centuries, have been preferred choice of sound money. So how does this all relate back to precious metals? Well, in times of crises, economic crises, and loss of confidence of fiat currencies and the purchasing power those currencies can afford, fears of inflation, fears of instability in the financial markets and global economy, time and time again, big sophisticated investors, central banks, and even individual investors have turned to precious metals as a form of sound currency or hard currency, something that can't be printed out of thin air. It's physically constrained. There's only so much precious metal elements in this world, and they're increasingly harder to mine and extract. So there is, for all intents and purposes, a limited or at least a restrained supply of precious metals, which is the opposite of fiat currencies, which can be printed to oblivion. Many people can remember imagery from the lead up to World War II, where people in Germany were taking wheelbarrows full of Deutsche Mark currency and putting it in their furnaces because it was more economical to do that than to go out and buy coal, which was suffering from massive runaway inflation. This is what happens when the purchasing power of fiat currencies gets eroded. So I'd like to turn to a chart of precious metal prices over the last bunch of years. This is a chart of two popular exchange traded funds that hold silver and gold. The green line, and these are monthly bars going back to 2006 or so. So the green line is for silver. It's an ETF SLV, which holds silver bullion. And the purple or fuchsia line is for GLD, a comparable ETF that holds gold bullion. Now, this is not a recommendation for either of these securities. In fact, there are other ETFs that in some ways we like way better than these from a storage and accountability standpoint. Here's the run up in 2011 that I talked about, and then the vicious decline here. And then you had this period from about 2013 to 2019 where those precious metal prices languished. And it wasn't until 2019 that they perked up. And then just in the last couple of years, and especially last year, we had a very, very sharp rise higher. Now you can see in both cases, both gold and silver have eclipsed those 2011 peaks quite substantially. And this is why people are wondering if this latest episode is just another example of what happened in 2011. Let's look at the investment performance of gold compared to the S&P 500. Now, there are all kinds of charts people can put out here and cherry pick dates, starting dates to make one investment look better than the other. I intentionally chose October of 2002, which is essentially where the sell-off in the tech bubble sell-off bear market ended. That marked the bottom, October of 2022. So it was a good starting point to be starting to invest in stocks. And yet what you see here from 2002 till the end of 2025, gold had a point-to-point better performance than the S&P 500. Now, you can also see that the pathway for gold here was much more volatile. You had a rise, big decline, sideways pattern, and then a very sharp vertical move here. But the point-to-point return here has been better for gold than the S&P. Now, here's where I'd like to point out the framework I think people should think about precious metals, not as an investment per se, but as an alternative currency, an alternative, for example, for U.S. investors to the U.S. dollar, which is under pressure. In fact, the U.S. dollar has seen quite a bit of decline. I think just this year to date, it's lost about 10%. And it's been in a multi-year, multi-month decline. We're still not at the lows, for example, that we saw in the early part of this century. But the point being, the US dollar has seen pretty sustained weakness. And there's a lot of policy belief that the policy objectives of at least the current administration is to see the dollar weaken further. They may not say that out loud, but that is, welcome for a number of different reasons, not the least of which it makes the competitiveness of our exports much more affordable on the global stage. But anyways, I urge people to think about precious metals not as an investment per se, but as an alternative currency, especially as a hedge against currencies like the US dollar and other fiat currencies that are susceptible to being eroded by rampant printing. And it's in that context I'd like to present a different chart comparing the S&P to gold. So this here chart, again, presents the S&P 500 from October of 2002 through the end of 2025. You see a massive move higher. Yeah, there was a sell-off here in the housing bust and a sell-off here in COVID, but a massive move higher. But if you price that S&P 500 return, not in dollars, but in gold, in gold terms, you can see the S&P has actually lost money over that time frame. So it's all a frame of reference as to the underlying currency that the investment is priced in. And that's why we think very proper portfolios should have investments in things like precious metals to help diversify. Now, again, against the policy and economic backdrop, I do think we are in the midst of a multi-year bull trend in precious metals. I do think in the years to come, we'll see precious metals prices eclipse even the recent highs that we saw. But that does not mean a bullish secular trend does not mean that these prices are immune from wild swings, and certainly in short-term periods. Talked earlier today about today's price action, one of the biggest down days ever in gold and silver prices. These are all things that we should expect to happen. Maybe not of this magnitude, but all still can be consistent with a longer-term secular bull market trend. And that, again, is what we think is in play. Now, what does this mean for investors and actual insights that I'd like to impart? So first off, many folks who have had precious metal allocations in their portfolios, including our clients, we highly urge you to reposition or rebalance down to a proper target level. Many people, for example, had a triple or more in their silver investments or a double or more in their gold investments. And the percent of their total assets that are allocated to these precious metals has grown to a imprudently large percentage. Absolutely, we encourage folks to sell. And that still is just a little chink in the armor of the massive gains that we've seen over the last couple of years. Absolutely not too late to sell down and take some chips off the table to a more prudent position. If you don't have precious metals exposure, we think you should start. We think you should add some. And it doesn't have to be a large position. In fact, position size is everything. We think Ray Dalio, I talked about earlier, he thinks that most investors, even passive investors, should have between 5 and 15% allocated to precious metals. That's essentially what our advice is, to think about 5 to 15%. And you don't have to get there all at once, especially where we are in the cycle. Absolutely, start small. Maybe start at 5% and dollar cost average in over several weeks or months or something like that. Point being is you shouldn't be paralyzed. It's not too late to add precious metals. We think it's an important diversifier. And frankly, if precious metals don't go up, it probably means that other things are going to go up instead. And it's what portfolio diversification truly is. I think a small 2% or 3% allocation is probably not enough for the kind of environment that we see in the years ahead. So again, target 5 to 15%. If you don't have any, start to scale in. Now, what I want to make very clear is, and excuse the pun, precious metals are not a silver bullet. They're not the be-all and end-all for everything. You should not have 100% of your money in precious metals. You should not have a overly concentrated position in precious metals. 50% we think is too much. 80% too much. Of course, everything is relative to any one individual situation, but 5 to 15% is absolutely appropriate for many people, not excessive in our opinion. Can you have more than that? Sure, but it's all dependent upon your circumstances. The other thing I want to make very clear is, our investing and encouraging for folks to invest in precious metals is not to say you should be completely out of the US dollar. Absolutely not. The US dollar is still the global reserve currency. It's under attack in many ways. It's likely to be devalued, but it doesn't mean you should have zero exposure to that, especially if you're a US investor. It's why you have precious metals. It's to hedge what exposure you do have to the US dollar. After all, when you want to live your life and buy things and spend things on your lifestyle, you're doing so in dollars. So ultimately, we encourage folks to convert their precious metals to US dollars to enjoy. And absolutely, if there are things in your life that you want to get done or enjoy, whether it's home improvements or a trip you've been putting off, couldn't think of a more appropriate reason to sell some precious metals that you might have to do that. But really, it's all about diversification. And it goes beyond precious metals. We think other types of real assets, real estate when priced properly, we think that's largely in a bubble of sorts now as well. But other commodities, base commodities like copper and iron and companies that mine for these things like natural resource companies, these are all important diversifiers we think that should be in a client portfolio. So I hope you found this big picture kind of commentary on the fundamental and economic backdrops of precious metals and related items helpful. I encourage you to subscribe to our channel. If you do, we put content out every week or thereabouts on a variety of topics. We'd love to hear your comments and feedback in the comments to this video. Tell us what you'd like to see. Subscribe, hit that little bell icon so you get alerted to future content we put out. And the team here at New Harbor Financial, we welcome questions and inquiries from folks. Certainly our clients know that we're highly accessible to them. But if you're not a client, feel free to call in. We'd welcome a no obligation, no pressure conversation with you about your situation, especially if you have questions about the kinds of things we talked about today. So I want to thank you for watching. And until next time, I want to wish you a good day.